Girish Kousgi, Managing Director and CEO of PNB Housing Finance, joins us now. Girish, good morning. Thank you for joining us. We've historically seen that in and around festival season, home finance companies or HFCs, they come out with what could be called as festival offers. Are we in for a repeat of the same this year where festival offers could come? They could start as early as Dussehra?
Good morning, Nikunj. So I think if you typically look at any year, Q3 and Q4, would be the best ever quarters in the year. And the festive season starts from Q3. So we can't rule out there could be some offers, but not, it won't be really major one because the demand is so high and most of the companies is doing well, sector is doing well. So whatever offer is there, I think that could be limited to some waiver in the processing fee. Otherwise, it won't be any deep discount in terms of rates or the fee.
This is happening because banks are right now in no mood to lend to home loans, because in home loan your spread is lower, and when your credit offtake is so strong, if you are even lending to a corporate or even if you are lending for working capital requirement, you enjoy better stress. So more bang for buck for banks at least is not in HF's home loans, it is in other loans.
I think if you look at the banking industry now, most of the banks, they are facing challenge because deposit raising has become a bit of a challenge, and because of that, CD ratio has to be corrected. So two things could happen. One is they need to mobilize more deposits, or in some way they may have to go little soft on credit growth. So I think that would, in a sense, open up opportunity for the NBFCs and housing finance companies. Having said that, I think demand in this sector, housing sector, is very, very good, and it is increasing with every passing quarter.
And where do you see the long-term 10-year rates and 20-year rates settling for the industry now?
I think that will be a very difficult question to answer. I am not an expert, but I think yes, sometime during the year we could see a bit of rate drop. I think the cycle would start, but it will take time. We were anticipating this to happen anytime during Q2 or Q3. Now it looks like it might get slightly pushed towards end of the financial year. But I think coming year we could see some rate cuts. But having said that, long term, if you see, it will be more stable. I don't think so. We'll ever go back to rates where the rate went down to about 6.5, 6.75 on the home loans, or on the other side, it will not even go beyond 13, 14%. I think it will be more stable, consistent. If you look at last few quarters, the cost has been going up, rates have been going up. Now, this is the cycle where the rate drop would start. And it will be more consistent in next couple of years.
Back to that original point of mine, which is that couple of years ago, and this was like 2021 and 2022, a little bit in 2023, we saw what could be called as a brutal price war in the HFC market. State Bank of India and PNB led it from the front. Since that time, they had a lot of CASA, and a lot of savings were moving into CASA, a lot of savings were moving into fixed deposits, largely because of the COVID impact. State Bank of India and PNB Housing, I distinctly remember, had cut their HFC offerings. You think that brutal price war in the HFC space is behind us?
I think to a certain extent it will be behind us, given the context of the challenges what the sector, more from a banking point of view is concerned, because the CD ratio has to get corrected. And also today, if you look at, I think the money is not really flowing into as deposits, probably it is getting into other asset classes. And therefore, at least for next 4 to 6 quarters, we may not see very severe competition from the banks. Having said that, since the demand is quite good, a lot of housing finance companies are getting more aggressive, and you could see good growth rates for the industry.
On the other side is that real estate prices have gone higher. On an average, we are talking about 50 becoming 70 and 70 becoming 150. Do you see that for HFCs, the average ticket size, which used to be in and around 20 lakh rupees at India average, that has multiplied? Are you also seeing that at PNB Housing, the loan wherever you are dispersing them, the average base number has gone up significantly in last 1 year?
I think if you look at the real estate industry during COVID, the prices went down significantly in certain markets. And I think the correction started from 2020 October onwards. In last 5 to 6 quarters, it has gained a lot of traction and the prices are back. There are certain markets where the prices have gone up, more than what was anticipated. But I think going forward, the price could consolidate and definitely with this, the ticket size across all the segments in retail, whether it is super prime, prime, emerging, has actually gone up. So it has helped in a way. But in the from a long-term perspective, the price shouldn't increase drastically. So I think now it was only a correction because the rates had gone up during COVID and post-COVID, slowly it recovered. I think most of the markets today, real estate, prices are quite stable. Going forward, price increase, could get moderated.
Uh, I'll also like to draw your attention to where the liquidity is moving for HFCs. While we've spoken about, how banks in a sense are getting options. If the liabilities are less, they want to perhaps lend into pockets where spreads are higher and HFC spreads are lower. I'm setting the context for our viewers here. But given that Reserve Bank of India now is no longer tightening liquidity and liquidity is going to get easier and easier, how will that change life for HFCs?
I think for housing finance companies, liquidity post-COVID has never been a challenge. During COVID, of course, there was a challenge. Post that has never been a challenge. Because I think if you look at last 2, 3 quarters, I think market borrowings have little softened in terms of pricing. Bank term loans have gone up because of various requirements, various changes, what has gone through in last few quarters. So as I mentioned, the cycle will change very soon, maybe end of this year, and the rates could start dropping. I think cost of loan would be a problem. Cost of credit was a challenge for last couple of quarters for some of the players in the NBFC, HFC space, but not credit per se. So there was enough liquidity, and there were multiple sources from which HFCs and banks could, HFCs and investors could source. Only thing is the challenge was on cost. I think now that will start going down. So it should really help the industry, both NBFCs and HFCs.
Okay, everybody is focusing on the salaried class. Everybody I speak to, even your peers, they say that look, we only want to pay or give it to folks where there's a predictable cycle in terms of understanding the payback. At PNB Housing, what is the split? Salaried versus non-salaried class?
I think PNB Housing as a strategy, we changed a strategy a couple of years back. So in terms of profile, we like salaried, self-employed, and self-employed non-professional. So all the three we like, but if you have to look at split within retail, it's about 65, 66, and the rest is self-employed. 66% is salary, and the rest is self-employed. And we would like to maintain this mix on the profile. But if you look at the focus from government, if you look at the focus of most of the housing finance companies, at least in last few years, the focus has been really on emerging and affordable because that is where they would get better margins and be more profitable. So the minute you get into emerging and affordable, there has to be a share which has to be significantly higher than 30-35% on the self-employed piece. If you look at affordable, the mix ideally would be 50-50, 50 salaried and 50 self-employed. If you talk about some of the matured segments like super prime and prime, where typically almost all the banks, PSU, private banks, large housing finance companies focus. So there the focus will be more on salaried. I think it all depends on the cost structure and the margins, which they settle into. So if you want more margins, you need to move segments more towards high yielding segments, and the mix would change more skewed towards self-employed. And if any institution is pretty okay with the margins, then they would focus more on salaried.
All right,
But
sir.
I think, yeah.
Appreciate your time, sir. Really appreciate your time and good luck for the festival season demand. We are just going to shift sectors and I'm